I watched my best friend lose $40 million in 6 months. He called me at 2 in the morning, his voice trembling, the sound of someone who had just watched his entire life collapse in slow motion. "Charlie," he said, "I don't know what to do. I have nothing left." I could hear the silence after those words, like the echo of a door closing forever. People think wealth is destroyed by bad luck, by market crashes, by some force of fate that can't be controlled. That's rarely true. More often, it's destroyed from the inside out, by one decision, one assumption, one moment when confidence turns into arrogance. That night, listening to him break down, I realized again a truth I've seen play out for nearly a century. It's not hard to make money. It's hard to keep it. I've been rich for over 60 years. I've seen entire empires rise and fall, friends go from jet planes to bankruptcy courts, and families lose 3 generations of effort in a single financial season. And most of the time, it wasn't fraud or misfortune that ruined them. It was something far more ordinary, success that made them careless. When you first start, you fight to escape gravity. Every dollar you earn feels like a victory. You analyze, you calculate, you think in probabilities. But once success arrives, you stop checking your math. You start believing in stories instead of statistics. You stop asking, "What if I'm wrong?" and begin assuming you're right. That's the moment the countdown begins. The danger of money isn't in having it. The danger is in what it does to your judgment. It seduces you into mistaking momentum for skill, and luck for genius. It makes you forget that survival, not brilliance, is the real test of intelligence. When people see wealth, they see freedom, comfort, admiration. What they don't see is how fragile it can be, how one wrong bet, one over-leveraged move, one illusion of certainty can wipe away decades of discipline. Over the years, I've watched hundreds of people destroy themselves, not because they didn't know how to win, but because they never learned how to stop losing. They built fortunes on good ideas, then erased them with bad habits. Overconfidence, impatience, and the eternal human itch to make something happen faster than it should. And the irony is, these people weren't foolish. They were intelligent, ambitious, often brilliant. But intelligence without humility is like a race car without brakes. It performs beautifully right up until the moment it doesn't. That's why I've always said, avoid stupidity before you chase brilliance. Most financial tragedies aren't the result of failing to be smart enough. They're the result of refusing to be cautious enough. I've spent my life studying human misjudgment, the predictable ways in which clever people sabotage themselves. And if there's one pattern that repeats again and again, it's this. When things are going well, people double down. They mistake a tailwind for talent, and they push the throttle when they should be checking the fuel. My friend was no different. He was successful, admired, and convinced that he finally understood the secret code of wealth. He didn't. I remember hanging up that night and sitting alone in the dark, thinking about how thin the line is between stability and ruin. I've seen men build for 30 years and destroy it all in 6 months. I've seen them trade safety for excitement, prudence for pride. Every story ends the same way, with that same phone call at 2 in the morning asking the same question, how did this happen? Here's the truth that few people learn in time. Getting rich is arithmetic. Staying rich is geometry. Arithmetic teaches you how to add. Geometry teaches you how to stay in shape when the world twists. My friend mastered the first but failed the second. And this is the price of one wrong decision. The moment when knowledge of how to make money collides with ignorance of how to keep it. Let me tell you about him. His name was David. We met in law school, 2 ambitious young men who thought intellect could outsmart the world. Even then, David had that glint in his eye, the kind that made people trust him, invest in him, follow him. He had charisma, confidence, and just enough impatience to make things happen. After graduation, while I went into investing, David built his own path in real estate. He started small, single-family homes, then small apartment buildings, then commercial complexes. He understood leverage, timing, and negotiation. Within 30 years, he'd built a portfolio worth $40 million, diversified, cash flow positive, and steady. He had everything people work their entire lives for: income, security, and time. At 50, he was the picture of success. 2 homes, one in Santa Barbara and another in Lake Tahoe. A wife who had supported him since the days he was fixing toilets himself. 2 children who were just finishing college. He liked to say he'd made it the hard way. Self-made, no shortcuts, no inheritance. And then, one dinner changed everything. A new acquaintance, let's call him Mark, invited David into what he called a once-in-a-lifetime development opportunity. A luxury condominium project on the edge of a fast-growing city. The market's on fire, Mark told him. We can pre-sell half the units before construction even starts. David did his homework, or at least what he thought was homework. The projections looked irresistible. 50% return within 18 months, 70% pre-sales expected before completion. The bank was willing to lend against his existing properties at 3% interest. On paper, it was perfect. That's how destruction begins, on paper. The numbers looked so good that David started believing them instead of testing them. He remortgaged his core properties, liquidated his stock portfolio, and emptied his cash reserves. He put almost everything, nearly 90% of his net worth, into that one project. At first, everything seemed to validate his decision. Construction began on time. Buyers lined up. By the third month, 60% of the units were reserved. The financial press was glowing about the unstoppable luxury boom. David was on magazine covers. He told me over lunch, half joking but half believing, that by the end of the year he'd be worth $100 million. I remember warning him gently, "Don't mistake momentum for immunity." He smiled, waved it off, and said, "Charlie, this time it's different. It's never different." By month 4, interest rates started climbing, just 0.5% at first, then another. Buyers, who had reserved units with small deposits, began backing out. Construction costs surged nearly 30% due to supply chain shortages. Labor costs followed. What had been a $40 million project was now tracking toward $52 million just to finish. Still, David held on. He believed the storm would pass. He borrowed more to cover the gap, confident the market would recover. When lenders started tightening, he personally guaranteed new loans. Every move pulled him deeper into the quicksand. By month 5, the pre-sales that once looked like a gold mine evaporated. Cancellations piled up. Banks demanded additional collateral. The debt service ballooned from $250,000 per month to nearly $500,000. The project, once his pride, turned into a bleeding wound that wouldn't close. And then came the final blow. His financing partner defaulted. Mark disappeared into another state. The subcontractors stopped showing up on site. The city halted construction over unpaid fees. David's phone became a weapon. Every ring another demand, another lawsuit, another deadline he couldn't meet. By month 6, it was over. The properties he'd spent 30 years building were foreclosed. His accounts were frozen. The project went bankrupt. The bank auctioned the land for pennies on the dollar. $40 million. Gone. When he called me that night, I could hear the disbelief in his voice. It wasn't the loss that broke him. It was the realization that he had done it to himself. He said, "Charlie, I worked 3 decades to build this, and I destroyed it in 6 months." He wasn't looking for sympathy. He was looking for understanding. How could something that felt so certain unravel so completely? I told him the truth, the kind that doesn't comfort you, but can save you if you accept it. You come back by never making that mistake again. Because wealth is fragile when built on the illusion of control. The real danger isn't volatility, it's overconfidence. David had built a strong empire, but structured it to survive perfection, not imperfection. I reminded him of a principle I live by. If you can't survive being wrong, you're already wrong. David's problem wasn't the market, it was concentration. He had violated the one rule that separates the wealthy who stay rich from those who don't. He had bet everything on being right once more. In finance, a 50% loss requires a 100% gain just to get back to even. A 75% loss requires 300%. But a 100% loss, that's terminal. There's no compounding your way out of zero. David thought he was immune because he was experienced, because he'd been through cycles before. But history doesn't repeat itself. It rhymes. And he mistook a familiar rhyme for a familiar outcome. The price wasn't just financial. His wife, once his partner in every decision, couldn't bear the humiliation of losing everything they had built. His children stopped asking for advice about business. The friends who used to invite him to dinner stopped calling. That's the hidden cost of ruin, not just the numbers, but the erosion of dignity. He moved into a rental apartment, sold the car he loved, and started consulting to pay legal bills. The man who once financed entire developments was now negotiating to settle his own debts. When people lose everything, they think the pain comes from poverty. It doesn't. It comes from identity collapse, the loss of who they thought they were. For months, he kept asking me the same question. How could I have been so stupid? And I told him what I've told hundreds of others over the years. It's not stupidity, it's human nature. Success rewires your brain. It teaches you to trust your instincts, to act fast, to double down when you feel momentum. Those reflexes make you rich, but they can also make you blind. The same traits that create fortune, if left unchecked, guarantee its destruction. I've seen this pattern too many times. 99 out of 100 who bet everything eventually lose it. You only hear the one survivor's story, and you call it genius. You never hear from the 99 who quietly rebuild their lives in shame. That's the bias that ruins people, the myth that you'll be the exception. David wasn't an exception, he was the rule. And I tell this story not to condemn him, but because I've stood at that same edge myself. Moments when opportunity whispered louder than reason. The difference is, I learned early that no single deal is worth risking your survival. You can be wrong 100 times and still get rich if you stay in the game, but you only have to be wrong once, and all the brilliance in the world can't save you. That's the real lesson here. Wealth isn't preserved by intelligence, but by restraint. David built his fortune by being bold. He lost it by forgetting that boldness without limits isn't courage, it's vanity. Getting rich is arithmetic. Staying rich is geometry. He mastered the first, but never learned the second. And this is the price of one wrong angle. The fall that begins when pride outruns prudence. When David lost everything, I realized how misunderstood one idea still is, even among the wealthy. Diversification is not the same as protection. People repeat the word like a spell, believing it guarantees safety. I'm diversified, they say. I own stocks, bonds, real estate, maybe a bit of gold. They think owning different things means being safe, but that's not safety. That's comfort disguised as strategy. Diversification protects you from a single point of failure, not from systemic collapse. When the tide goes out, all boats drop together. In 2008, stocks crashed, real estate crashed, commodities crashed, and even cash became fragile when banks froze credit. Diversification didn't save anyone. It only meant they lost money in more places at once. That's when I began using a word most investors still don't understand: anti-fragility. It's not mine. It came from Nassim Taleb, a friend and philosopher who described something I had practiced instinctively for decades. The idea that there's a difference between being strong and being unbreakable, between surviving chaos and actually benefiting from it. Fragile things break when pressure rises. Robust things survive when pressure rises. But anti-fragile things improve when pressure rises. That's the whole ladder of wealth survival in 3 lines. Imagine a wine glass. It's beautiful, elegant, but if you drop it once, it shatters. That's most people's financial structure. They look rich, polished, impressive. But one unexpected shock, one lawsuit, one market crash, and the whole thing is dust. Now imagine a plastic cup. It doesn't shatter. You can drop it, and it stays intact. That's robust wealth. It doesn't grow, but it endures. Diversification gives you that. It keeps you from total ruin, but it doesn't make you stronger. It's like wearing armor that keeps you alive, but weighs you down so much that you can't move fast enough when opportunity appears. But then there's something else, something alive, your immune system. Every time it encounters a pathogen, it becomes stronger. It learns, adapts, builds memory, or your muscles. You lift weights, tear the fibers slightly, and the body rebuilds them stronger. Stress doesn't destroy them, it trains them. That's anti-fragility. Now imagine building wealth that works like that. A system that grows more resilient, more profitable, and more adaptable with each crisis. When the market crashes, you buy great assets at half price. When inflation rises, your cash flow increases with it. When regulations shift, your structure bends, not breaks. You don't fear chaos, you feed on it. That's what anti-fragility means in money. It's not about avoiding risk, it's about using volatility as fuel. Fragile wealth depends on prediction. Robust wealth depends on protection. Anti-fragile wealth depends on positioning. You can't predict the next recession, the next war, or the next black swan. I'm 99, and I've stopped trying to guess. But what you can do is build a system that wins no matter what happens. One that gains from disorder instead of collapsing under it. Most financial advice is designed to make you feel less anxious, not more intelligent. Advisors talk about diversification because it feels safe. It gives the illusion that risk is under control. But true safety doesn't come from feeling calm. It comes from being ready when everyone else panics. When something breaks, when a recession hits, the fragile investor panics. Their debt magnifies the loss. Their assets are illiquid. They're forced to sell at the bottom. The robust investor survives. They lose value but endure. The anti-fragile investor smiles quietly. They've kept cash reserves. They have patience and emotional calm. They buy what others are forced to sell. They make the crisis their ally. That's how Warren and I built Berkshire Hathaway. We never pretended to predict when the next downturn would come. We simply structured our portfolio so that when chaos arrived, we were not only safe but advantaged. Think of it like architecture. Fragile buildings collapse in earthquakes. Robust buildings resist them. Anti-fragile structures, like modern skyscrapers, flex with the quake. They absorb the energy, convert destruction into motion, and return to stillness stronger than before. Wealth can be built the same way. The key is accepting uncertainty as a permanent condition, not a temporary problem. The world doesn't stabilize, it mutates. Markets evolve, politics shift, technology disrupts. Every system you depend on today will be obsolete in time. The investor's job isn't to predict these changes, but to design a portfolio that thrives through them. When you truly grasp that, fear disappears, because you stop asking, how do I avoid loss? And start asking, how can I benefit from volatility? It's a mental inversion, the kind of thinking I've always loved. Instead of fighting randomness, you make randomness your partner. Fragile wealth depends on hope. It assumes the future will behave like the past. It's often over-leveraged, over-concentrated, and emotionally dependent on things going right. It grows fast, but it dies suddenly. Robust wealth depends on defense. It avoids catastrophic loss through diversification and cash buffers. It survives storms but gains nothing from them. Anti-fragile wealth depends on optionality. It maintains resilience through flexibility. It has cash to deploy, multiple streams of income, and exposure to asymmetric opportunities, where the upside is large and the downside is limited. It gets stronger with stress. Diversification creates robustness, not anti-fragility. The former keeps you alive, the latter makes you evolve. So, the question isn't, how can I diversify? It's, how can I structure my wealth so that shocks benefit me instead of harm me? Every investment, every decision, every partnership must answer this test. If the world turns upside down, do I die, survive, or grow stronger? If the answer is die, I avoid it. If it's survive, I limit exposure. If it's grow stronger, I double down. That single framework saved me for 60 years, through recessions, crashes, inflation, deflation, and everything in between. Because I never built for certainty. I built for endurance. When markets boom, I raise cash. When everyone's euphoric, I get quiet. When panic arrives, I act. The crowd sees chaos. I see a stress test revealing who is swimming naked. Anti-fragility means you don't just survive that test. You look forward to it. And this mindset extends beyond money. Relationships, health, knowledge, they all follow the same rule. Stress, properly managed, strengthens. Avoiding it weakens. The person who never fails never grows. The investor who never experiences a loss never learns the math of pain. The business that never faces crisis never develops muscle. Anti-fragility isn't about liking chaos. It's about harvesting its lessons faster than others. You cannot eliminate fragility completely. The world itself is fragile, but you can ensure your fragility isn't fatal. You can build layers, safety nets, redundancies, liquidity, and habits of patience that turn danger into opportunity. Over time, the difference compounds. The fragile investor rides high in bull markets and disappears in bear ones. The robust investor treads water through both. The anti-fragile investor accumulates the losses of others, buying when fear peaks and compounding at the expense of panic. That's how fortunes endure, not by brilliance but by asymmetry, not by prediction but by preparation. The goal isn't to predict tomorrow. It's to stay alive long enough for compounding to make prediction irrelevant. You don't need to be right often. You just need to be hard to kill. Once you understand that, wealth stops being about the size of your portfolio and becomes about the structure of your survival. And now that you understand the philosophy, it's time to make it practical. Philosophy without application is entertainment. Anti-fragility without structure is just a good story. In the next part, I'll show you how to build this into your own system. The 5 operational principles that turn chaos into growth. Position sizing, liquidity reserves, passive cash flow, multi-scenario diversification, and preemptive disaster preparation. Because wisdom means nothing if it doesn't change how you survive the next storm. I've spent a lifetime watching bright people ruin themselves, and the pattern is always the same. They ignore the simple arithmetic of survival. Making money is addition. Losing it is multiplication by 0. Once you multiply by 0, nothing else you ever add will matter. That's why the first rule in my system is never to put yourself in a position where you can lose everything. People think risk is something they can measure with models and charts. It isn't. Risk is what's left after you've thought of everything that could go wrong. When I look back at the investors who disappeared, they all made one quiet assumption, that tomorrow would look roughly like today. Then, one day, it didn't. I remember a friend in the 70s who believed he'd discovered a formula in the commodities market. For a while, he was right. His returns compounded at 30% a year, and he felt invincible. Then, a shipping strike froze supply lines, and the entire model collapsed. Within months, he'd lost 70%. The math of drawdowns is merciless. Lose half, you need 100% to get back. Lose 75, you need 300. Lose 90, you need 900. People forget that recovery grows exponentially harder while ruin grows linearly easier. I learned early that no return is worth the possibility of permanent loss. Survival before growth. That's the only equation that matters. When I build positions, I never let any single idea exceed a quarter of my net worth. Even when I was certain, absolutely convinced, of a deal's merit, I kept the exposure at 25%. Certainty is seductive. It whispers that you're smarter than probability. But I've been wrong often enough to know better. Once in a while someone asks, what if you have an extraordinary edge? I tell them edges dull faster than egos. If you truly have one, maybe stretch to a third, but never with leverage. Debt turns minor errors into mortal wounds. I've watched leverage do what heroin does. It feels good the first time, manageable the second, and terminal the third. Most people violate this rule because they confuse conviction with safety. They think being right makes them invulnerable. It doesn't. The market doesn't care how smart you feel. The only safety is structural. How much you can lose and still play tomorrow. If your top position exceeds a quarter of your wealth, you're not an investor. You're a hostage praying the guards stay friendly. The discipline isn't glamorous, but it's the reason I've stayed rich longer than most people have stayed alive. Check your own exposure. If one bet dominates, start unwinding it now. Take 90 days and trim until you could lose it entirely and still sleep. If you can't sleep after that, you're overexposed to yourself, not to the market. I've survived long enough to learn that losing everything once is usually enough to teach humility. But humility alone doesn't keep you rich. Flexibility does. Liquidity is flexibility made tangible. Cash is the oxygen of survival. And most people suffocate not because the environment changes, but because they've used every breath on growth. Liquidity buys you time, and time is what turns chaos into opportunity. The problem is psychological. Idle cash feels like failure. In a bull market, holding cash is like standing still in a marathon while everyone else runs past. You feel stupid until mile 23, when half of them collapse. I usually keep between 10 and 30% of my net worth in cash or near cash instruments. The exact number depends on the environment. When interest rates are high, liquidity pays you to wait. When they're low, it costs you a little tuition to buy optionality. If your income is volatile or your portfolio carries leverage, you keep more, closer to 30. If your cash flow is stable and your assets are low volatility, you can live closer to 10. The rule is dynamic, not dogma. Liquidity is not there to make you rich. It's there to keep you rational. When everyone else is desperate, you're composed. When others sell what they love, you buy what they hate. I've made more money from having cash in bad times than from any clever idea in good ones. There was a period in the 80s when I had the chance to buy a property development at an absurd discount. The numbers were perfect except for timing. I didn't have immediate liquidity without selling securities I wanted to keep. I waited 6 months. People told me I'd miss it. I didn't. When the financing dried up, I bought the land outright. No debt, no partners, no noise. The return wasn't spectacular, but the peace of mind was. Liquidity let me dictate terms. It always does. The cost of cash is visible and small. The cost of illiquidity is invisible until it kills you. If less than 15% of your wealth is liquid, raise it by a point or two each month until you can breathe again. Cash is your permission slip to think. Liquidity buys you time, but time alone won't pay your bills. Independence isn't measured by net worth. It's measured by the ratio between your passive income and your expenses. I've seen men worth hundreds of millions crumble because every dollar they earned depended on them showing up. They called themselves rich, but they were only well paid. True wealth is when your money works harder than you ever could. That's why I care less about valuation than about cash flow. Market prices are opinions. Income is fact. If your portfolio stops generating income the moment you do, you're still an employee, just with fancier stationery. I've always structured my holdings so that dividends, interest, rents, and distributions cover more than my lifestyle. When that coverage ratio exceeds 100%, you cross the line from independence to invincibility. Because even if everything else goes wrong, the inflow continues. The psychological benefit is enormous. You stop making decisions out of desperation. You wait. You choose. People underestimate how dangerous desperation is. When you have no incoming cash, every problem becomes urgent. You sell at the bottom, borrow at the top, and confuse movement with progress. Passive income removes that pressure. It doesn't have to make you rich quickly. It just has to keep you from being forced to act stupidly. Build streams that don't depend on your labor. Own businesses that run without you. Properties that pay rent even when you're sick. Securities that send checks while you sleep. It might take 5 years to reach full coverage, maybe 10. But once you do, life becomes probabilistically unfair in your favor. You can afford patience, and patience is the rarest edge left. Still, income isn't enough, because no matter how steady the stream, every plan is built on assumptions, and assumptions are fragile. Most people destroy themselves not because they're wrong once, but because they bet everything on being right once. The longer I've lived, the more I've learned to design as if I'm wrong about everything. That's not pessimism, it's statistical realism. The world rarely behaves exactly as you expect. The trick is to make sure that being wrong hurts less than being right helps. That's why I never anchor my future to a single scenario. I hold assets that do well when inflation rises, others that do well when it falls, some that thrive in growth, and some that protect me in contraction. If interest rates collapse, fine. If they spike, also fine. I don't need to guess. The aim is not maximum return, it's minimum regret. When I build portfolios, I think in 4 quadrants. Up and inflationary, up and deflationary, down and inflationary, down and deflationary. Something in each box. You don't have to fill them equally, but you must fill them consciously. That way, no single macro event can knock you out. The psychology here is subtle. People crave certainty because uncertainty feels like incompetence. They'd rather be confidently wrong than humbly diversified. But uncertainty is permanent, and humility compounds. Each time you admit you might be wrong, you buy insurance against overconfidence. I once said, I'm never sure about anything, and that's why I survive. It's true. If your wealth only works in one future, it's already broken in the present. Map your own assumptions. Ask yourself, what if rates rise instead of fall? What if taxes double? What if my best asset becomes illegal to operate? If the honest answers scare you, you're fragile. Of course, even if you plan for being wrong, the world can still surprise you in ways no model predicts. That's why I don't just think about risk. I insure against disaster. Most people see insurance as an expense. I see it as anti-fragility in its purest form. Paying a small, certain cost to avoid a large, uncertain catastrophe. Life insurance protects your family from your mortality. Disability protects your income from your biology. Liability protects your assets from other people's mistakes. Property protects your shelter from the planet's chaos. Each policy is a seatbelt you hope never to test. I've spent millions on premiums over decades and barely filed claims. Some people call that waste. I call it proof the system worked. Insurance isn't limited to policies. I maintain redundancy everywhere. Multiple income streams, multiple custodians, multiple jurisdictions. If one system fails, another stands ready. It's not efficient, but efficiency is the enemy of endurance. Engineers learned this long before investors did. Every bridge has redundant cables, not because they look pretty, but because one day, one will snap. Your finances deserve the same courtesy. Keep at least a year of living expenses in cash. 2, if your income is volatile or your assets illiquid. That buffer is what separates an inconvenience from a catastrophe. I've seen brilliant entrepreneurs lose decades of progress because they never planned for a dry season. They optimized everything for growth and left no slack. Then a single disruption, a lawsuit, a pandemic, a policy change, erased them. The problem wasn't intelligence, it was design. They built race cars for straight roads and forgot that real life has turns. Preparation looks boring until the unprepared start screaming. I keep checklists for disasters the same way pilots do. What happens if the market halves? If my partner dies? If I'm incapacitated? If our systems are hacked? Each scenario has a procedure before the emotion arrives. Planning in calm saves you from improvising in panic. The time to buy an umbrella is before the rain. Over the years, I've noticed that redundancy not only protects wealth, it protects character. When you know one failure won't end you, you become kinder, more patient, more willing to think long term. Fear makes people selfish. Security makes them rational. That's the ultimate dividend of anti-fragile design. It pays in behavior, not just in dollars. When I combine all of these, what emerges isn't 5 separate tricks, but one complete organism. Position sizing limits fatal wounds. Liquidity buys time. Passive income buys freedom. Scenario diversification guards against arrogance. Disaster preparation ensures continuity. Together they form a single immune system that turns volatility into nourishment. You stop being afraid. You stop checking prices every morning. You stop reacting. Instead, you watch the world fluctuate and think, good, the machine is working. This is the structure that carried me through 6 decades of chaos. The stagflation of the 70s, the crash of '87, the dot-com collapse, the financial crisis, the pandemic panic. Each event tested the system and left it stronger, because when you build for survival first, growth becomes inevitable. The weak chase speed, the strong chase durability. I prefer being the last man standing to being the fastest sprinter in a race that ends at a cliff. You don't need brilliance to do this. You need discipline. Most people fail not for lack of intelligence, but for lack of patience with boredom. The rules sound simple, almost dull. Never overconcentrate. Keep cash. Build passive income. Assume you're wrong. Prepare for disaster. But executing them every year, quietly, without excitement, that's what creates the compounding others call luck. If you want a place to start, begin small. Look at your biggest position. Could you survive losing it entirely? If not, trim. Check your liquidity. Could you live 12 months with zero income? If not, build cash until you can. Examine your expenses. How much of them are covered by passive inflows? Increase that ratio every year until it passes 100%. List your assumptions about the future and imagine each one reversed. Strengthen the weak points. Then ask yourself what single event could ruin you tomorrow. Buy protection against it today. The process is not glamorous, but neither is staying alive. Over time, you'll notice something interesting. The calmer you become, the luckier you appear. That's not luck, that's design. Chaos favors those who have built for it. The storm always finds the weakest roofs. I just made sure mine could bend without breaking. I once said that all I want to know is where I'm going to die, so I'll never go there. These principles are the map that keeps me away from those places. They're not about maximizing returns. They're about minimizing regret. Because wealth doesn't belong to the cleverest. It belongs to the most durable. Survival before growth. Always. And if you build your system that way, you'll discover the quietest truth in finance. The longer you stay in the game, the less you need to gamble. The longer you survive, the richer you become. Almost by accident, chaos becomes your partner, not your predator. That's what I mean when I say anti-fragile wealth. It's not a theory, it's a habit. You build it one conservative decision at a time until one day you realize nothing outside your control can destroy you. Then you can finally stop chasing fortune and start living like someone who deserves it. When you build a system strong enough to survive chaos, something unexpected happens inside you. You stop being afraid, you stop chasing news, checking prices, and measuring your worth against a screen. You start thinking in decades instead of days, and then you realize the real purpose of wealth was never luxury. It was calm, the freedom to think clearly, to make choices without fear, to wake up and know that no external storm can take away your peace. That's the moment money stops owning you. I learned this late. For much of my life, I was obsessed with the architecture of survival. Ratios, positions, liquidity, diversification. But there's another side to wealth that numbers can't capture. You can have perfect balance sheets and still be internally bankrupt. I've seen men who had every hedge in place but no rest in their minds. They built fortresses of capital, but lived inside them like prisoners. Staying rich is not just about preserving assets. It's about preserving the character that built them. The longer I've lived, the clearer it's become that enduring wealth rests on three pillars that have nothing to do with markets: energy, relationships, and time. These are the invisible compounding forces. Neglect any one of them, and no amount of financial prudence will save you. Energy comes first because without vitality, you can't make or keep any rational decision. I have known investors who could memorize every financial statement, but couldn't sleep more than 4 hours, or eat a meal without stress. Exhaustion makes fools of all of us. When you're tired, risk feels smaller and reward feels closer. Your mind trades discipline for relief. I tell younger people, protect your sleep as fiercely as you protect your capital. It's the cheapest insurance you'll ever buy. A tired mind believes in miracles. A rested one only believes in math. Energy also means curiosity, the mental vitality to keep learning. The moment you stop learning, the world quietly moves you from the winning side of compounding to the losing one. Every decade rewrites the rules, and those who grow stale get left behind. Physical health, intellectual humility, and emotional balance, they're all forms of capital. And unlike money, you can't delegate them. The second pillar is relationships. Money doesn't test character. Relationships do. Who you partner with, who you trust, who you share your ambitions with. All of these choices decide whether wealth compounds or corrodes. I've seen fortunes destroyed not by markets, but by the wrong people. Partners chasing status, friends selling excitement, spouses who confuse love with leverage. The people around you are your emotional portfolio. Choose those who make you saner, not richer. Choose those who slow you down when you're euphoric and calm you when you're scared. Surround yourself with people who measure success by stability, not spectacle. In my experience, FOMO doesn't start in markets, it starts in relationships. You envy someone's return, not their peace. You start mimicking their bets, their style, their urgency. Before long, you're playing their game, not yours. I've learned that the greatest financial discipline is relational discipline, saying no to noise disguised as friendship. Keep a small circle and make sure they speak truth, not flattery. One honest skeptic is worth more than a dozen cheerleaders. The third pillar is time, or rather, your relationship to it. Most people spend their lives acting like time is infinite, and money is scarce when it's the other way around. You can always earn back money. You never earn back time, yet people trade years for a few more dollars, thinking there will be some final point where they can stop. There isn't. You don't win the game by having the most. You win by knowing when you have enough. Defining enough is the only way to avoid playing games that never end. I've seen brilliant investors blow themselves up, not because they needed more money, but because they didn't know how to stop. They won the race and then kept running until their legs broke. Enough is a moving target if you never decide where the finish line is. I wrote down my own definition decades ago. Enough is when your money can't buy you anything more important than your peace of mind. After that, compounding serves purpose, not ego. Time also compounds like capital. The more wisely you allocate it, the more value you extract from every hour. I schedule thinking time as if it were a meeting with my future self. Time to read, to sit quietly, to look at what's not working. Most people fill their days with movement, thinking it's progress. I prefer stillness. Stillness lets you hear the signal beneath the noise. When you align energy, relationships, and time, money becomes a byproduct, not the goal. You start designing your life like you design a portfolio, structured for endurance, balanced against volatility, diversified across meaning. Health is your liquidity. People are your dividends. Time is your compounding rate. Together they make you anti-fragile, not just in wealth, but in spirit. But philosophy means nothing without practice. So I keep one small ritual, and I recommend it to anyone who wants to stay sane in a chaotic world. Every Sunday, I sit down for 30 minutes with a notebook. No phone, no screens. Just paper, pen, and silence. I write 3 numbers and 3 sentences. The first number is my largest drawdown of the week. Financial, emotional, or mental. Where did I lose energy? What mistake cost me calm? The second number is my coverage ratio. How much of my expenses are still covered by passive income? If it's slipping, I correct it before the month ends. The third number is my optionality score. How much flexibility I currently have. Can I walk away from anything that doesn't serve me? If not, I start building slack again. Then I write 3 sentences. One thing I'm grateful for, one thing I need to say no to, and one lesson I want to remember next week. It's a trivial exercise, but over decades it keeps you honest. You see your fragility before the world exposes it for you. People chase complex systems, but all you need is a habit that forces reflection before correction. That 30-minute review has saved me from more bad decisions than any spreadsheet ever did. You see, the discipline that keeps you rich is the same one that keeps you healthy and kind. It's the ability to pause, to notice the impulse before it becomes a commitment, to recognize when you're acting out of fear, envy, or fatigue. Every financial disaster I've witnessed began as an emotional one, a small loss of composure that turned into a large loss of judgment. The best investors I know are calm, not because markets are stable, but because their minds are. If you get the 3 pillars right, life simplifies. You stop trying to impress people you don't respect. You stop running races no one wins. You spend your time with those who add energy instead of draining it. You rest, you read, you think. You build a rhythm of discipline and quiet that compounds into wisdom. That's the real yield of wealth, clarity, not consumption. And if you ever forget what matters, remember this. Chaos is always waiting to test your structure. It will attack your finances, your patience, your relationships, your health. You can't avoid it, but you can decide how you'll meet it. If your system, both external and internal, is anti-fragile, every shock will leave you stronger. The storms of life aren't interruptions. They're calibrations. They remind you what's real. I'm old enough now to know that the game was never about becoming richer than others. It was about becoming wiser than my former self. The scoreboard isn't your net worth. It's how quietly you can sleep. If your mind is still noisy when your balance sheet is full, you haven't won yet. Real wealth is when you no longer need to prove you have any. So, guard your energy like your capital. Choose your people like your investments. Spend your time as if it were your most volatile asset, because it is. Do those 3 things, review them once a week, and you'll find yourself gradually compounding into someone who can face chaos with a smile. The markets will rise and fall, fortunes will come and go, but the calm of understanding, of knowing what truly matters, will outlast them all. That's the quiet reward at the end of a long life of compounding, the peace of being unshaken, the serenity of knowing that whatever happens next, you are already enough. When you reach the end of a lesson like this, the temptation is to nod, feel wiser, and move on. Don't. Wisdom only compounds when it's converted into behavior. Knowledge without structure is just noise inside the brain. I've seen more fortunes eroded by inaction than by mistakes, because the mind confuses understanding with execution. So, before you walk away, I want you to do one thing that could quietly change the trajectory of your financial life. Take out a sheet of paper, yes, paper, and write down 5 answers. They're not numbers for me, they're mirrors for you. The first question is simple. What percentage of your wealth sits in your single largest position? If that number is above 25%, you're already carrying a hidden time bomb. Maybe it's a company you built, maybe a stock you love, maybe real estate you can't imagine selling. It doesn't matter. The math of survival doesn't care about sentiment. Start a 90-day plan to bring that exposure down by 5%. Small reductions compound into big protections. The second question, how many months of expenses could you cover tomorrow if all income stopped? If your answer is less than 6, you have liquidity risk. Ideally, you should have 12 to 24 months in liquid or near cash assets. More if your income is volatile, less if it's stable. Cash isn't laziness, it's permission. Over the next month, Raise your liquidity by 2 or 3%. Each percent is an extra breath in a crisis. Third question, what percentage of your living costs are already covered by passive income? If that ratio is under 100%, you're still dependent on the treadmill. Set a goal. Within the next 3 to 5 years, build one new stream that covers at least 1% of your monthly spending. Dividends, rent, interest, royalties. It doesn't matter which door the cash walks through, only that it walks in while you sleep. Fourth, write down the key assumptions your wealth depends on. Maybe you assume markets will keep rising, interest rates will stay low, or your health will remain perfect. Now invert each one. What if markets fall? What if rates double? What if you're forced to stop working? If any scenario would erase your safety, you're fragile. Draw a simple 2x2 grid, up or down, inflation or deflation, and place a seed in each quadrant. The point isn't to predict, but to diversify across realities. Finally, ask yourself what disasters you haven't prepared for. Not small losses, catastrophes, lawsuits, illness, death, disability, data loss, or political upheaval. For every risk, there's an instrument, insurance, a trust, a second account, a backup plan. Buy at least one missing piece this week. It will feel unnecessary. Every safety measure does, until the day after you need it. Those 5 answers will show you exactly where your foundation cracks. You don't need to fix everything overnight. You only need to start. The first step rewires your brain from theory to practice, from spectator to participant. Most people wait until the storm hits. The few who prepare now will spend that storm buying assets from the panicked. That's the entire secret of long-term wealth. Act before others react. I have often said that compounding works best for the patient, but it only exists for the survivors. The way you ensure survival is by transforming these questions into habits. So here's a simple challenge, 7 days long. Each day repairs one weak point in your system. On day 1, reduce your top position by 5%. On day 2, increase your cash holdings by 2 or 3%. On day 3, begin a new passive income stream that can eventually cover 1% of your monthly costs. On day 4, buy the insurance policy you've been postponing. On day 5, sketch your scenario map, that humble 2x2 grid of possible futures. On day 6, create one redundancy, a second bank account, a new jurisdiction, and additional backup. On day 7, write your own one-page document called Investment Rules. Sign it, date it, and tape it where you can see it. That paper isn't decoration, it's a contract with your future self. If you complete that week, you'll already be ahead of 95% of investors. They talk about diversification. You'll have practiced anti-fragility. They chase growth. You'll have engineered survival. You'll start noticing a calm that feels unfamiliar. The quiet confidence that comes from knowing you can't be wiped out by one mistake. That's not arrogance, it's design. When you finish the checklist, take a moment to breathe. Then look around your life. The real measure of success isn't how many risks you took, but how many you can now afford to ignore. If you can watch markets swing without panic, if you can say no to trends that make everyone else restless, if you can wake up knowing your family is protected and your future is intact, then you've already won. Money beyond that point is just a magnifier of who you are. People often ask me for quotes, something short they can remember when the noise gets loud. I don't have slogans, I have reminders, small truths condensed by time. Avoid stupidity before you chase brilliance. If you can't explain it, don't buy it. Boring compounds better than exciting. 6 great businesses beat 60 random ones. 1% in fees equals 3 decades of work. Your emotions are your worst advisor. Wealth rewards those who wait. Tape those on your wall if you must, not as decoration, but as guardrails. They're the shorthand for everything I've learned the hard way. You don't need to be heroic to get rich, and you certainly don't need to be a genius to stay rich. You only need to be deliberate. Every decision should lengthen your runway, not shorten it. Every opportunity should be judged by a single test. Will this increase or reduce my ability to survive mistakes? If it increases it, proceed. If it reduces it, walk away. That rule has saved me from more disasters than luck ever could. Now, if you've listened this far, it means you're serious. You're not chasing dopamine, you're chasing durability. Most people quit at understanding. You've stayed for the discipline. And discipline is where wealth actually begins. So take the next 7 days seriously. When you finish, come back and tell me what changed, what position you cut, what policy you bought, what you realized about yourself. Share it with others. Help someone else build a system that lasts. Because the real compounding doesn't happen in markets, it happens in minds. And if you ever find yourself forgetting these lessons, remember this one sentence. It will outlive every cycle, every trend, every crash. Survival before growth. Always. If you honor that hierarchy, chaos will never terrify you again. It will become your silent partner. A reminder that strength is not the absence of stress, but the ability to grow because of it. Build your anti-fragile system, protect your future, and let your life, not your portfolio, be the evidence that you understood. Now go do the work.